Welcome back, everybody, to the Half Truth, and where we're going to dissect some different articles and give you some thoughts and opinions, give you some of the what they're talking about in the article, and then the actual truth, and maybe some of the half truths. So there's, I know we got some good things in store today. I found an interesting one actually just before we jumped on. So let's go ahead and let's dive right into it. So. Apparently, today marks the day that the big company BlackRock, which basically, for those of you who don't know who they are, they're probably the largest asset manager in the globe, at least in the U.S. Second to, or Vanguard would probably be another one. But long story short, they launched a suite of target date fund exchange traded funds. So, we know a little bit about those target date funds, not our favorite thing for sure. And, but now BlackRock's got a suite of them. So, for those of you who I guess want to be lazy and not actually take care of their finances in retirement, maybe that's what you should go with. I will say though, with it being an exchange traded fund, those are going to be cheaper products than a mutual fund. Typically, target date funds are focused on mutual funds. I'm not going to get into how they actually work, but most of them sell, mutual funds in various asset classes. At least with an exchange traded fund, you'll save a little bit on cost. But at the end of the day, target date funds, in my opinion, are going to be one of the worst things that you could do to save for retirement. If you don't want to do anything, sure. But usually when you don't want to do things, what do you end up with? Something that you're not satisfied with. So I would say invest a little bit. Sorry, go ahead.
It goes back to what we talked about last week. The lawsuits that are coming out. It's just another way for them to double dip on the fees. That just shows that those lawsuits are going to mean nothing. Like, let's say they win, but they're just going to keep doing it. Nothing's going to stop them from doing that. People are going to forget about it and just going to roll into something new. So
what do they say? They just repackage up the shit and sell you a new bag of shit.
Exactly, with a new bow on it or something. Yeah. Well, everybody listening to, we don't get together. We don't share the articles that we're going to do. So that was a new one to me and everyone that he brings forward and I bring forward. We haven't rehearsed this. This is just new information for both of us that we're sharing with each other.
Yeah, and I mean, back to, like you said, more money that's going to be taken away from the investor and the hard worker who's contributing to their retirement, whether it's a 401k, IRA, Roth, whatever you want to call it. So yeah, beware of those things, and really, when you read the article, and I'm going to talk about this on a few of the other articles. I get tired of reading these articles of what would you do if I'm, such age with X amount of money, and then every person who writes the article is like, well, it always depends on your circumstance. Well, no shit. Of course it does. And if you're actually reading that article, you probably, who really reads those? I see them all the time and I'm like, well, maybe you should take life into your own hands. Maybe do a little bit of research and not read a dumb article that talks about, hey, it all depends on, what your circumstances are. Anyways, we'll get into that because the two other articles. Yes. Sorry. But right, so BlackRock launches. Go ahead.
Go ahead.
Oh no, I was just going to say, that was. You go ahead, buddy.
We have a lag on a video today. Mine always starts with Jim Cramer, only this time on the lighter side. I'm not going to rip on Jim Cramer, but he interviewed my man crush, Ryan Reynolds. And Ryan Reynolds, over the last few years, has made over $450 million. But he insists he's not a pro investor. He says experts have forgotten more investing knowledge than he'll ever know, which is true for most people. I mean, even every advisor, there's always somebody smarter and understands it better and things like that. The kick that I get out of it is that he didn't make his money in the stock market. He made all of this money by investing in real business. That's where it's not necessarily a skill, but it takes time and effort and massaging and doing things. I mean, look at what he's done over the last couple of years with what he's invested in. He's not talking about making $450 million in the stock market. Like that's a crapshoot. That's a casino. He's investing in real stuff, which they don't talk about that. And dickhead Jim Cramer doesn't mention that at all.
Well, we know he didn't make it from Green Lantern.
Right, yeah.
I don't know.
Thank God, let's never mention that movie again.
I did actually see that. Not that. No, to your point, not that I knew you were going to talk about that, but I did happen to come across at least the clickbait tagline for that. But yes, to your point, there's, you look at George Clooney, another example. Somebody that didn't make his money in the stock market, owning gold, owning bonds, owning Nvidia. No, he made it in Batman Returns, where he played probably the worst Batman. But that's up for debate. No, he made most of his money as an actor, and then of course investing in, like Patrick said, businesses, things that are alternative. We did touch on that in one of our previous articles.
By the way, I just got to mention, I'm really digging the grandma bedspread you got behind you there.
I know, right? Isn't that thing cool?
Very fashionable.
Hey, keeping it real, I got the Dumb and Dumber poster. For those, you can't see the other ones, but there's a Tombstone poster as well as a Pirates of the Caribbean. So I've got them all in here, but this one is my favorite
room, by the way.
Pretty much. All right, so
moving on. What else you got?
Yeah, so my next article, we'll go right into kind of where I left off before, was, so this one's titled 4 Ways to Grow $100,000 into $1 million for Retirement. So I'm gonna run through these bullet points to you. Luckily, there's only 4, and then I'll tell you what's good and bad about all of this. So once again, $100,000, $1 million when you retire, basically a 10xing your portfolio. And in this article, they say over 30 years, which, okay, that's somebody that's starting out, putting money in, or had saved a little, started with, call it when they were 30, and they grew it to $1 million when they turned 60. So first one, go with high quality real estate investment trust. Second one, find growth with companies. Find a growth company with a big moat. 3, find a growth company that's ramping up its growth cycle. And 4, ride a can't miss trend. So I'm going to open this up for both of us. I see you already laughing, because I was laughing at this when I first started reading it, because I'm like, really, go with high quality real estate investment trust. So Patrick, let's pick this part a little bit. Though we both are investors in real estate and love real estate, I think there's not enough information here. It's very ambiguous. And if you go ahead and touch on a point or two, and then I'll follow up with some of the ones I was going to mention.
Well, yeah, and I don't want to get too deep into this, but to go back to your original thought of the other one, of the Ryan Reynolds one, the clickbait, that title was a clickbait to get people to click on it. And out of the 4, they're all focused on the stock market, which again counteracts what we just talked about with the Ryan Reynolds thing of making money outside the stock market. And that's every article, everybody's focusing on that stocks are the only game in town. And then to your other point of this is an investment advice for everybody, or it depends on the person's specific situation. So, I mean, these articles are all the same, when we get into it, and just stupid. And when a real estate trust, that's a liquid investment that's going to go down with the market. Right now, If you look at what real estate trusts have done this year, they've tanked, just like the stock market has.
Yep. Yeah, and I would just add that, if you look at, so for anybody that watches this, and perhaps Patrick and I can throw up a chart, but if you go back to, call it, the year 2000 and then all the way to now, so call it from 2000 to 2010, we'll say 2008, right before the financial crisis, so we had the dot-com era, right, that came and left pretty quick. Then we had a whole era of, where interest rates were really low. We were trying to get, people were buying these adjustable rate, or homes with adjustable rate mortgages, all of that fun stuff. So what I'm getting at here is once we got through the financial crisis, through then until we got through it and started our growth pattern, the stocks that were going up in those times were completely different than the ones that went up from 2010 to 2023 to today. So my point is, just because over the last 10 years a certain sector has had a ton of growth doesn't necessarily mean that the next 10 years you're going to have the same kind of growth pattern, because I don't think, and both Patrick and I have talked about this privately as well as in other areas, that the next 10 years between now and call it 2030, 2033, the high tech stuff, the high tech growth is probably not going to be where we're going to make our money. So I would just, these things, like we both, beating a dead horse here, it's very boilerplate, very, why can't I think of the word?
A long-winded way of saying the leaders in the past, after a reset recession, not the leaders going forward.
Oh, thank you. So sum that up with that.
There we go.
But yeah, so they're just very ambiguous about what they're trying to say.
Yeah, and yeah, they're just getting viewers is what they're trying to do. Getting people to read the article is what they're going for, the ads. Yahoo Finance came out with one that said, and I have a feeling we're going to start seeing more of these. Inflation is higher than the Fed wants. The problem could be its target, meaning the 2% target that the Fed has is too low, and now they need to adjust that to maybe 3%, 4% of inflation target rather than the 2%. And I think this is starting the trend of getting people in the mindset of be like, okay, it's going to be too costly, too hard to get down to that 2%, which is still astronomical at 2% inflation, to get people, used to a higher inflation going forward. And keep in mind, if we have a 4 or 5% ongoing inflation, that's going to be detrimental to retirements, to everybody saving for retirement. Like, if that's going to be the new target, watch out. Like, that's scary.
Well, you have nowhere for someone that's fairly risk adverse. I mean, at least right now, if we believe that inflation is at 4%, you can go get a 12, 18-month CD for 6%. So at least you're slightly above it, not by much, but slightly above it.
Right.
But yeah, to your point,
and real inflation is much higher than the 4% that they're reporting.
Right. That's a very good topic. I think we could talk about that.
Well, it goes into, our segue from last episode, the revisions. They come out, for the last how many months, at least the last 6 months, they've revised their numbers. So they'll come out with a print of a number to try and not scare people, and then they'll revise them down where people aren't paying attention anymore, so that they can get a little closer to the true value, and not scare the masses into, panic selling in the markets.
Agreed. Well, let's see here. Moving along, do you want me to talk about mine, or we want to continue on with any more on that one?
No, we can move on to the next one.
Okay. So I've noticed this thing since we've started this, and it's called, I see it a lot on Yahoo Finance, but I've seen it in other places. It's called Ask an Advisor. Here we go, more clickbait. Should I be moving stocks to bonds? I'm 65 and have 82% of my 401k in equities. Oh boy. So here we go.
How old?
I'm 65.
Okay.
So my biggest problem after reading through this article, and of course, opening line, I'll read the first part, just I'm not going to go through the whole thing, but it says, let's see here, Bob, while it's not a satisfying answer, the real answer is, here we go, it depends. Let me guess on what you do, your lifestyle and what you're thinking. Look, at the end of the day, of course, what this person's talking about in the article matters. What your lifestyle is, those things. What they forget to neglect to talk about is when you're 65, your runway is a lot shorter than when you're 55, 45, 35. So, in my opinion, and I think Patrick, you'd probably second this, in my opinion, if you have a shorter runway, I don't even care if we were in 2012 and we had the next 12, the next 10 years in growth like we've had. You're 65. If something goes wrong, all that money that you've worked so hard for, it's going to take you far longer to recover. And that's what one thing that they neglect to talk about. And that's kind of why I was saying, the ambiguousness of a lot of these articles. And so yes, somebody that's 65, 82% of your portfolios in stocks and equities, well, based on, throw out where our market's at right now. If it were me and I was telling this person what to do, I'd be like, hey, look, immediately we need to shift your portfolio because you need to preserve what you made. Why would you take that risk at all? You can go
Well,
put your money. Go ahead.
it's we're at the point, like you're saying, where we're at in the markets, whether it was 10 years ago, but this is the same mindset of a lot of people. I feel like, people have gotten complacent. The easy money has been made and they think that the market will reset, but it'll come back. To your point of the time horizon, sure, it'll come back. Will it come back before you're dead at age 65? Probably not, so it's all about the time horizon type of thing. And equities are a casino. So yeah, I totally agree. It's asinine. You should have come out straight out and said it. And that's the other thing is people need advice. They need a financial advisor. You writing to an article and getting some ambiguous response is not going to help your portfolio, not going to help your situation.
Right. And I mean, think about this. If you're 65 years old and listening to this, or myself, putting myself as being 65, do I want to have the headache and stress of my portfolio losing 20, 30% in a given year at that age? No, I want to be sipping margaritas in Margaritaville and just collecting a decent percentage, maybe having a small amount that's maybe bigger because of my age at 65 that is exposed to more growth type situations. But I'm sorry, but if I'm 65 and I've amassed a decent 401k, IRA, whatever, the last thing I'm doing is keeping it in the stock market. To your point, gambling.
And we're not saying yes, shift from equities to bonds, because bonds have gotten hammered, too. And unless you hold it to maturity, you're getting screwed on your bond purchase too. So you have to be very strategic in your bonds. But there's a lot of things right now that, yeah, you can get a nice 5, 6, 7% and sit, and it's fairly secure, and you can just sit on that for the rest of your life and generate your income, type of thing. But do I recommend putting everything in there? Heck no.
No, never. Diversification is a real thing.
Yeah. I'm going to switch to the real estate market. So a lot of people don't know I have my real estate license too. And obviously when you sell a house, the broker gets a commission. So recently, and this has happened in the past too, recently real estate brokers pocketing up to 6% in fees draws an antitrust scrutiny. Obviously it's why every real estate agent out there is saying now is a great time to buy, now is a great time to sell. They don't give a crap about you. They want that 6% commission. I know from selling real estate, the 6% commission it should not be paid. They're not worth the 6% commission, especially 90% of real estate agents out there. They just don't know what they're doing. They're cowboys. They don't care. They just want that commission. They want that fat check. And to be honest, they're just paper pushers. So for them to get 6% now in the Midwest, maybe because the prices are smaller. In California, definitely not. There's no reason that you should be getting a $60,000 check from $1 million sale on a property. That is just asinine. But this is just a short-term hiccup because of prices. It'll go away, and agents will still be getting that 6%.
Yeah, I would add that it's kind of like think about the subprime mortgages back before the financial crisis. You had a lot of guys that went and took a test and could sell mortgages and didn't know, sure, they knew what they were selling, but they didn't know what the economical factors were on what they were selling.
Or care.
And so you had, or care, right? Well, because they had a Mercedes or they had whatever car that they purchased because they just closed, the 100th loan, for that year, whatever it was. But, so again, more cowboys creating more problems. I agree. I don't even get me started on real estate agents.
All right. What else you got?
Those were my three, but I did have another thing that I wanted to let me see here. I wanted to bring up, and it was, I think I'll just have you probably share it when you create the or send out the video rather.
While you look at that, I have one that we both will probably enjoy because we're both into aviation. I watched a video on this before this article came out about the economics of doing this, but United has announced and they will debut a new boarding order to save time. Southwest does it best. And the reason Southwest does it, and I'm not endorsing Southwest, they're a pain in the butt. There's a lot of things I don't like about Southwest, but the reason why they do it better, because they don't have all the priority boarding, you pay for extra or, pre-board and all that type of crap. In order for them to truly expedite this, they need to do away with all that and go with a certain strategy of how to get people in. They've done research on this, of how to really expedite this. So this is just a pomp and circumstance of United to try and say, hey, we're doing better to get you on, and all that type of stuff, when in reality they're going to do away with it. They're going to roll this out, find out it doesn't work in the masses or it doesn't really save them time, and they're just going to roll it back and go back to their old way.
Well, that sounds like fun. You're going to be traveling a lot coming up here, so are you flying Delta?
I'm on United on the next trip. Yeah. Well, actually, no. The next trip is Delta, and then United after that.
Oh, okay. Well, I guess trying to keep it short. Maybe we can bring this up for next week's call or video rather. Is and I got a good chart I'll share with you, Patrick. And it talks about basically the all of the corporate debt that's maturing over the next, call it, between now and 2030, and whether it's leverage loans, high yield, investment grade, and I think we might be able to have a good conversation around how people were borrowing money pretty cheap, less than a handful of years ago, and they were going out and getting a loan, $50 million loan on 3%, and then putting it in something that's gaining 6%, or call it, 3% and getting 5%. So they got a 2% there that they're making. Anyways, a lot of these loans, or a lot of these, loans that they borrowed against are, going to be coming due over the next month or the next few years. And I think this chart would be a fun one for us to talk about. Well, guys, I think that's, what we got for today. Please feel free to leave any comments or suggestions if you find an article that you think is at least you want us to take a look at and we can give you the half truth on. Let us know. But Patrick, it's always fun to do these things, especially the last, 3 weeks, 4 weeks or so.
Yeah. Be sure to tune in next week for another great episode.
All right, guys. Well, the half truth today. We'll see you next week. Thanks.